Thank you for joining us. The following presentation is for my webinar titled Year-End Tax Legislation. How will this affect you? Originally produced on January 22nd, 2015. The presenters are David Riley, Ryan Rutt, and Dan Matarrese of McKonly and Asbury. Enjoy the presentation and visit us online at www.macpas.com for information about our future events and upcoming webinars.
Welcome to this McKonly and Asbury webinar. We will be discussing year-end tax legislation and how it affects you and your business. My name's David Riley. I'm a tax manager with our Entrepreneurial Services Group, which serves our small business clients and their owners. And I am joined by Dan Matarrese in our PCS group and Ryan Rutt, who is a corporate tax manager in our tax department. Let me start by asking maybe Ryan, there was new tax legislation passed. It was the Tax Increase Prevention Act. It was passed in December, and it affects most businesses' 2014 tax filings, their tax situations. What's the most important aspect of this legislation, do you think, on businesses?
Well, thanks, Dave. Yeah, coming in the mid-December, there was this legislation was kind of widely believed to be, it was going to be passed, but it was kind of relief when it actually did pass because nothing's certain until it's signed into law. Mm-hmm. As far as from the corporate standpoint, from the business standpoint, the biggest piece by far would be the fixed assets. There's several components to that. Probably most popular would be the 50% bonus depreciation provision, which allows for 50% write-off of new assets under 20 years tax life. This is huge. There's no limitation as far as income or size of company. Any company can take 50% bonus. So that provision itself would probably be the largest. Another one to go along with that was the increased Section 179, or I should say the expansion of Section 179. This was an extension from 2013, 2012. Actually, both of these were 50% bonus and Section 179 were both extensions. Nothing really changed from 2013 to 2014 as a result of this legislation. Had it not passed, we'd be looking at fewer deductions for businesses. The Section 179 expansion, real briefly, instead of having a limit that would make most businesses ineligible to take the deduction, it now increases the size of the deduction to $500,000, and as long as you have less than $2 million of assets, you can take that full $500,000. The 50% bonus in Section 179 would be by far the biggest business impact.
Dan, how about for individual taxpayers? What do you think the largest impact on them will be from this legislation?
I think actually it's the same piece, the same aspect that Ryan spoke about would be bonus depreciation in 179. And the reason being that for owners of pass-through entities or self-employed individuals, that additional depreciation deduction or acceleration of depreciation deduction is the most meaningful to their pockets in the immediate future. So for an example, let's say we have a $4 million piece of equipment. Ryan, $4 million piece of equipment, what's the additional depreciation I may get from that under bonus, let's say?
Sure. Yeah. So if it's a new piece of equipment, mm-hmm. and normally equipment has less than 20 years of tax life, so it would be eligible for bonus. We can, in the first year that we place in service, 2014 in this example, we can write off $2 million write-off, 50% of it. Mm-hmm. And what that means, if you're comparing it to the tax rates on the individual side, you're looking at roughly $800,000 of savings if you're looking at a 40% tax rate.
That's right. Yeah, we have a highest marginal rate in the individual side of 39.6. So, 40%, as you said, for argument's sake. An addition $2 million deduction at 40% is meaningful. So if that asset was placed in service in 14, we now have taxable income for 2014 being reduced by $2 million over what it would have had this legislation not been passed. And we have the April 15th tax bill going down by $800,000. So that money now is put towards whatever other things businesses and business owners want to put that money towards.
Yeah, and one quick clarification on bonus depreciation and Section 179 as we talk about it. these are what we call temporary differences. At some point, the depreciation, we can take more depreciation now, we can take less later. So if you're looking at a particular time frame, let's take that one asset. Let's say it's a 5-year piece of equipment. Over 5 years, you'll get the same amount of deductions in total. But when we look at time value of money, when we can take, in this example, $2 million of a deduction right off first year, that's huge. That's huge for current year savings.
Mm-hmm.
While we'll have to pay that in the years coming up, that's still important for business owners.
So to clarify what you're saying, it sounds like I'm not getting an additional deduction kind of in absolute terms, but a deduction that would have been spread over 5 years or 7 years, I now get in 1 year, which rather than spreading my tax burden out, I get to realize the tax savings in right now by April 15th.
Yeah, in the current year, you're not paying as much. You'll pay the same amount in total, but we get the savings now. And by the way, this is we used a 5-year example in what we just talked about, that piece of equipment. Another piece of this legislation extended what we call qualified leasehold property. And real briefly, if you lease property, a building, if you don't own it or if a related party doesn't own it, that kind of goes into the definition of qualified leasehold. But if you lease property and you put in a massive renovation, again, there's certain restrictions, but for the case of this example, we'll say we had a $10 million renovation inside of our building that we're leasing. Normally, without this legislation, that property would have to be in at 39 years. And 39 years is a long time to spread out the deduction. Now that this legislation has passed, one of the provisions is that we have qualified leasehold improvements, which now can be put in at 15 years. And if you're paying attention to bonus depreciation, my definition, we can now take 50% bonus on that $10 million property. So we can take $5 million straight off, plus what we call the kind of the normal depreciation on top of that. We're getting a very front-loaded deduction on this improvement. And instead of taking 39 years, in total it's only going to take 15. That is huge savings when you're talking about time value of money.
Yeah, and I think that just in a climate, too, where if you're in a type of business, maybe, and this is hypothetical, too, you're inventory heavy, so you're on your line. So, you have some cost of that money as well. I think the idea of accelerating some deductions, and Dave, you alluded to it, it is just a concentration of the tax benefit in the earlier years of that asset as opposed to recovering your cost ratably over its full life. I think if you can get some more money into businesses and business owners' pockets up front, I think it could have some real savings in the way of interest charges or other things as well. So, there's definitely benefit, but it is good that we wanted to clarify that point here, that it is not overall an additional deduction or newfound deduction. It's concentrating or accelerating the cost recovery of this asset. With that being said, guys, we've had bonus for how many years? We've had 179 at similar levels for quite some time now. So it has become common practice to businesses as they evaluate CapEx and they evaluate improvements and different investments they're going to make in infrastructure. I think part of the equation has typically become this accelerated cost recovery for tax purposes because it has been the norm for so many years. So while if Congress did not act and pass this, essentially all it would have done is, change the year in which this deduction has taken. I think it has become common business practice now that we expect bonus. We expect 179. So inaction would have caused, I think, a pretty big change for businesses.
Yeah, that's a great point. I was gonna say, for those of you out there who wonder how this is different from 2013, the answer is it's not. It's the same. But we would be having the shockwaves would have gone out had this not been passed. So while it was, at least in the tax world, it was big news that it passed in mid-December. This was also kind of an extension of the status quo.
Right. The name of the act is very telling. Tax increase prevention. That if Congress had just been passive and not acted, it would have led to a much larger tax burden in the next couple months on most businesses and most individuals.
Right.
So they acted to extend a lot of these benefits. That being said, I hear you both saying for 2014, as businesses are thinking about their 2015 tax situations and their fixed asset additions and their quarterly estimate calculations, it's my understanding these provisions actually don't matter for 2015 yet.
That's right. I guess the maddening or frustrating part of it, if you want to talk about Congress and how late they passed this 2014 legislation. I mean, we had it broadly affects the filings of 2014. It happened 2 weeks before 2014 ended. Mm-hmm. And then most of these, or almost all of these provisions, expired December 31st, 2014. So now we're in 2015. As far as trying to figure out what they're going to do, your guess is as good as mine. If I had to take a guess at the very beginning, unless there's broad reform, which I don't think will happen personally, I would expect the same in 2015. You can't necessarily plan for that, but if you really wanted this is just my personal guess, watching this for the past number of years, it probably the same thing will happen in 2015. Dan, do you have any thoughts on that?
I think, Ryan, I think you're dead on in that, is that we've had this kind of dance, if you will, on is bonus coming, is it not, or are we going to let it expire? And right now Congress has essentially said they'll get to this last minute, and last minute does keep getting pushed back every year, but I would suspect the same thing. One of the aspects about this, typically bonus and 179 carry favorable weight on both sides of the political battle, if you will. There's not strong opposition from either party for giving incentive of investment in infrastructure and property, plant, and equipment. So typically you can then gather from this that there's you can have some confidence that overall across the political landscape this is something that's supported. So because of that, and as Ryan, you alluded to, the history of this continually being passed, even if it's late in the game, I think you can approach 2015 just as we did with 14. We know it's not known for sure yet, but we expect it to happen.
There are a number of other provisions as part of this act, specifically regarding credits to incentivize businesses to do certain things. And one of those credits incentivizes businesses to innovate and improve. Ryan, can you talk a little bit about what kind of credits there are available for businesses doing research and development?
Oh, sure. Well, kind of as Dan alluded to, the one that has one credit that has a lot of bipartisan support, or appears to have a lot of bipartisan support over the years, has been the research credit, or the R&D credit, or research and development credit. Again, this was part of the legislation, and I guess the big piece of it is that the news is that there's no news. It's the same as 2013. It's the same credit. It's kind of a little bit of a complicated calculation, but in essence, businesses can get credits for the research and development expenses. And much like Dan, I'll let you explain how this affects individuals, but much like the fixed asset piece, if you're a flow-through business, if you're an S-corp owner, if you're a partnership owner, you can still take these credits, but it's gonna flow down from the business to you.
Right, and I think that the R&D credit specifically, and in our practice, and of course, where we are in central Pennsylvania, then just the Northeast region, the flow-through entities, the S-corps, the partnerships, they really dominate, I think, the type of entity choice, and for good reason. For tax purposes, they're pretty darn efficient as compared to the C-corp model. So because of that, the concentration of these R&D credits end up flowing to individual tax returns, Ryan, as you alluded to. So we mentioned earlier we have a highest marginal rate for individual tax purposes of 39.6%. A lot of times for larger organizations that have a lot of pass-through income, which means their owners are in the highest income tax bracket of 39.6%. Let's say 5-6 million of income. They're beyond the reach of what you call AMT, or alternative minimum tax. And again, AMT, all intents and purposes, a parallel tax system. Different things you can and can't deduct, different ways you figure depreciation, and a different rate structure applied to it. The one, I would say, hang up, if you will, on the R&D credit is that it cannot lower a tax liability of a taxpayer below what they would pay under the AMT system. So for all intents and purposes, AMT is a 28% flat rate. And of course, the highest marginal rate is 39.6%. So what a lot of taxpayers and owners of these pass-through entities will see is they'll get a benefit of the difference between that 39.6 and 28. So about 11.6% tax benefit from each of these credits. And any unused credit is then carried forward 20 years. So made available to be used in the future. With that being said, R&D is still hugely valuable. Again, individuals that have high-income individuals owning very, very profitable high-income pass-through entities, these R&D credits can be hundreds of thousands of dollars per year that lower their tax liability. Unlike the fixed asset piece that we spoke about earlier, this truly is a tax savings that you otherwise would not have. Think about R&D is converting what is a deduction that reduces taxable income to a dollar-for-dollar credit that will offset tax. So it is more valuable. You're not going to have the same tax deduction or same tax liability if you look at 7 or 8 years in total if the R&D disappeared. You would have a larger tax liability. So this truly is, I would say, a fairly impactful provision from that perspective. Maybe I think you can argue even a little bit more impactful than the fixed assets pieces we spoke about.
Sure. And I want to take a quick second to kind of highlight something and kind of even backtrack a little bit. When we talk about 50% bonus versus 179, and now we're talking about the research credit. If something, the 50% bonus depreciation, by and large, unless you don't want a bigger loss, anybody can take it. There's not really a limitation to the amount. Any size company, when you can think of the name of the biggest names, it doesn't matter. They can take 50% bonus. That's not necessarily true for Section 179 because there is a dollar limitation on how many assets you place in service. I mentioned it completely phases out at $2.5 million of CapEx. However, even if you're below that and you're a business owner that has one of these flow-throughs that Dan, you were just alluding to, if you maybe have income at a business and that Section 179 expense flows down to you, but if you have a personal loss in total, you can't take it, and it would carry over. But this is something you want to kind of look at. It has to be a comprehensive planning about when a business will or will not take Section 179. There is planning involved with bonus as well, but when you're talking about something that flows down separately, like a Section 179 expense or research credit, you talk about AMT impact. You need to see the whole picture. You can't be just thinking, oh, this sounds good. I think we'll go ahead and we do research and development. We'll do this credit. That doesn't necessarily work that way. Yep. And I just wanted to make that distinction between bonus and 179 as well.
Yep. And Dan, you're saying if I am a taxpayer paying AMT, I could have a research and development study done, which tells me my credit amount that I can claim, but I wouldn't get any benefit from that?
Correct. If you're in AMT, the R&D credit and some of the other credits that fall into that general business credit category offer you no benefit in the current year, but can be used in the future in a year that you're no longer in AMT. If you're not in AMT, because, again, you're beyond the reach of it because you're in a higher income tax bracket, or if you have really large AMT preference or adjustment items that take you out of AMT, then it will only reduce your tax liability to what your tentative minimum tax is, calculated under the AMT rules. So it's important to be aware of, again, as Ryan talked about, Dave, you alluded to, if you're engaging to do an R&D study, there's cost to that, and for good reason. The studies have to be very thorough. And the people who do them have to be experts at them, so they can hold up if ever challenged. You have to weigh those costs of those studies with the actual tax benefit, and if it's not a current year tax benefit, how long it will be until you actually receive that benefit.
It seems like with both the R&D credit and 179 passing through to individuals, there are a lot of variables, not just at the business level, but at the individual taxpayer level to understand where their AGI will be, what their tax rate is, are they potentially an AMT or not. And at the business level, they need to know that to understand what the true economic benefit will be to the owners of the business. Mm-hmm. Another piece of this legislation, another incentive for businesses, are hiring incentives. Ryan, what type of hiring incentives are part of this tax provision?
much like the research credit, there is a credit that had been in place for years called the WOTC credit, Work Opportunity Tax Credit, WOTC for short, WOTC. It had expired, it did expire at 12/31/2013. 2 weeks before the end of 2014, they reenacted for the 2014 tax year. And again, now it's expired as of 12/31/2014. In short, this credit incentivizes businesses to hire people in what the IRS calls targeted groups. This could be ex-felons. This could be veterans. There are certain groups that are distinguished by the IRS, and if a hire falls into one of those brackets, the business is eligible to take a credit against the wages that they pay them. Again, this follows the research credit as well, where if it's a C corp where you're taxed at the entity level, you can take it at the C corp. But if you are a pass through, it's going to pass through down to the shareholder. Dan, can you speak how that operates? Because you mentioned how the research credit was limited. Is that the same for WOTC?
Great clarification. No, WOTC is not subject to the limitations of AMT on the individual side. So WOTC credits could potentially be a little bit more beneficial, all things being equal, because you're not subject to essentially that floor of tentative minimum tax to where it can't bring your tax below that floor. WOTC credits in general are probably not as, I don't want to say the word lucrative, but a little bit harder to come by than the R&D is in specific industries like engineering or manufacturing or construction, where the R&D credit is pretty prevalent and can produce big numbers. But with that being said, WOTC at the surface, because it's not subject to the limitations of AMT, can be a little bit more beneficial to taxpayers.
And I wanted to point out too, as far as actually figuring out what those credits will be, McKonly and Asbury doesn't actually do the studies that show what our credits are. However, if you do feel like you're in a position where you do hire a lot of ex-veterans or people with I think troubled youth or youth workers, something along the lines of something like that. These different groups, if you feel like you may fall in that category, a lot of times we see retailers, stores, that kind of thing, hire some of these groups, then feel free to reach out to us. We can get you in touch with companies that can do a study for you or see if you're eligible. Mm-hmm. Same goes for the research credit. Again, as I said earlier, the actual calculation can be a little complicated. But we can get that set up for you if you feel like you're doing research and development, or if you want to see if that could even benefit you. Feel free to reach out. We'd love to assist.
Although this year-end bill doesn't specifically address healthcare, the Affordable Care Act has been a monumental shift in not only in the way that we purchase health insurance and the way that health insurance providers interact with consumers, and it has tax impacts. And even though the bill is 4 or 5 years old now, it kind of has these phase-ins where its specific effect on taxpayers is evolving and changing with each year. So I want to come back to that bill just to understand for the 2014 filing, and as we enter 2015, that we understand the Affordable Care Act's continued impact on taxpayers. Generally speaking, the way that the Affordable Care Act works is that it set up these government-sponsored exchanges where individuals and small businesses could go onto these exchanges and purchase health insurance from private health insurance companies at a subsidized cost that made it more affordable for more people to have insurance, possibly that didn't have it before, and more affordable for small businesses who may not have been able to afford it to offer that benefit to their employees. It made it more affordable for them to offer health insurance to their employees. So the government subsidizes the cost of these health insurance premiums through these exchanges. As part of the legislation, though, they had to pay for that subsidy. Dan, what are some of the additional taxes that have been affecting taxpayers? What are some of those additional taxes that have been added to pay for those health insurance premium subsidies?
Yeah, and actually, Dave, as you said earlier, these are not specifically new to 14 or 15. They were in place starting in 2013, at least the biggest one was, and that's the Medicare surcharge. So Medicare historically was 2.9%. and that was shared shared responsibility of Medicare tax from an employee and an employer, 1.45% each, right down the middle. So if you notice on any one of your pay stubs, your W-2 at the end of the year, you see Medicare wages and Medicare tax withheld. So the Affordable Care Act bumped that 2.9%. It took the employee side of it, which the 1.45, and took it from 1.45, added 0.09, and made it 2.35% for those that earned more than $250,000 in 2013. So earned income now is subject to a higher level of Medicare surcharge, which goes to offset some of these subsidies being offered by the federal government. In total, Medicare becomes 3.8%, 1.45 on the employer side, as it historically had been, and 2.35 on the employee side for those higher income individuals. The real unprecedented and interesting piece of the Affordable Care Act is it took that Medicare tax and applied it for the first time to anything other than earned income. It applied it to your net investment income, and that's called the net investment income tax, or NIIT. Interest, dividends, or pass-through income from an entity you are not active in, passive in, rental income typically, is now all subject, starting in 2013, continuing in 14 and beyond, all subject to an additional 3.8% tax. So look at this in total. The highest marginal rate went from 35 to 39.6, plus you tack on this 3.8%. We ended up with a 43.4% tax rate for taxpayers, depending on the character of income they had. It is important to mention here from a planning perspective that there are some ways to mitigate the Affordable Care Act surcharge, the net investment income tax surcharge. Probably the largest is using an S corporation. If you own a large operating company that's producing a good amount of pass-through income, using an S corp will allow the pass-through income to you, if you're active in that entity, to escape the net investment income surcharge. And a similar thing would be if you're a real estate professional. So if you have a lot of rental income, but you are seen as a real estate professional, that rental income is not seen as passive. And that could be valuable in helping you save some dollars and not being subject to net investment income surcharge. And then finally, if you have self-rented income, so if you have an operating company and you also own the building that your operating company rents from, but in a separate entity, that income that flows through to you from the rental company, from the rental entity, is considered non-passive because it's self-rented and not subject to the net investment income surcharge. That's not something that is inherent on a form or on a K-1 that flows from the business entity. That's all about properly classifying that income on the individual's income tax return. So we did a lot of that in 2013, a lot of reclassifying or regrouping activities to make sure that we escaped net investment income surcharge. And we were successful with a lot of our clients. Other clients with just investable assets that are producing interest, dividends, or capital gains, there's really not a lot you can do. And that continues to be, I think, the largest funding of these government subsidized exchanges is collecting this additional Medicare tax that the government has in place since 2013.
So with for capital gains, is the surcharge still 3.8%? The reason I ask is I saw recently the capital gains rate being compared to new proposals, which we'll get to later, and the rate that was given was 23.8%. In my eyes, I thought it was 20, but is that just the 3.8 being added to?
Correct. So the long-term capital gain rate, or the same rate that's applied to qualified dividends currently, if you are in the highest income tax bracket, it's 20%. And if you're in the highest income tax bracket, you also eclipse the Medicare surcharge threshold, so you're going to have the 3.8% on top of the 20% long-term capital gain, bringing you to 23.8%.
So you'd automatically get taxed 23.8%, which is what the comparison was to, even though technically 3.8% of that is a Medicare surcharge.
That's right.
Mm-hmm. Got it.
So if you're an average Joe who just has an investment property that you rent out, or your family has a beach property that you rent out most of the year, is that going to be subject to the 3.8%?
Yeah, if you have positive net rental income and you're otherwise over those thresholds, so $250,000 of AGI for a married couple in that range, then yes, the positive net rental income is seen as passive and would be subject to the net investment income surcharge. It's a separate line item, a separate tax on your return. The two forms are Form 8960 and 8959. One calculates the additional earned income, or Medicare tax on earned income, and then the other one calculates the net investment income surcharge, just applying that 3.8% to your net investment income.
Dave, I've heard that for small businesses out there that are kind of dealing with the new law and further implementation, that there are credits out there available. Can you describe a little bit how that works on the business side?
Yeah, this is an important point to note, because this is an area where there's actually a change for 2014 filing. The original small employer health insurance credit, that was claimed for tax years 2010 through 2013. That was claimed just when you file your tax return. You would claim a credit, but there was nothing special in the way that you had to purchase your health insurance, because you weren't expected to do anything really differently when the Affordable Care Act was originally passed. So if you were a small employer and you were already offering coverage to your employees, the Affordable Care Act from 2010 to 2013 gave you a little bit extra in your pocket at the end of the year. That they allowed you to claim a credit against those premiums. Starting in 2014, you actually had to purchase your group plan that you were providing for your employees. You have to purchase that on the government exchanges now to be eligible to claim the credit. That's one of the changes. And just to review the basic criteria and definition of a small employer, the small employer, to qualify for the credit, needed less than 25 FTEs, full-time equivalents. Those full-time employees had to average less than $50,000 in annual wages, and you also had to provide more than half of the cost of their health insurance premiums. One of the criticisms of that law is that you're targeting a pretty small group of businesses. One of the things that we found in our practices is either most of our businesses have more than 25 employees, but those that don't pay their employees pretty well, so you're already over the $50,000 in annual wages. So you have to be that rare employer who has less than 25 employees, you're paying those employees on average less than $50,000, and you're covering more than half of their health insurance costs. Now, those criteria have remained the same going forward, but you have to purchase the plan through a government exchange. You can't just do it through your normal means, through your insurance broker. It needs to be through a government exchange.
So if I can just interrupt you, Dave, just from a theory standpoint, it's a really interesting point. We've heard that those government exchanges are subsidized by tax dollars. So we're saying now that those same employers have to choose a plan subsidized by the government so they can qualify for a credit, which further subsidizes their health care expenses.
Right. Now, one of the interesting things that I want to move to that's developing sort of in the health insurance market, as many of our small businesses have been considering changes to their health insurance coverage, changes to the benefits that they offer their employees, is that the rates for purchasing individual coverage are actually more competitive with group insurance plans than they have ever been. So typically, before the Affordable Care Act, it never made sense for you or I as an employee to go buy our own health insurance coverage. It made sense for the employer to pull their employees together, purchase a group plan, and provide that tax-free benefit because the premiums that our employer pay on our behalf are tax-free benefit to us. So they would provide that group coverage to us. However, since the cost of those group plans are rising, and it is easier for individuals to go on these exchanges and purchase health insurance plans at a subsidized rates, it's becoming more competitive for an individual simply to go on the exchange. So one thing employers are considering is, well, what if because of the expense and high cost of my group plan, what if I just get rid of my group plan and give all of my employees a stipend, or just say, we're not on a group plan anymore, but here's $3,000-$4,000, and you go onto the exchange and just buy whatever plan is best for you and your family. Dan, what are the implications for individuals in that scenario?
So on the individual side, individuals also need to have health insurance. There's a new box on line 61 of the 2014 Form 1040 where you select or check off if you have health insurance coverage for the year. And if you don't check that box, then the expectation is you will calculate the penalty and self-assess and self-report the penalty for not having your own health insurance. So let's just say that's out of the picture. You are going to purchase your own health insurance. So you receive that stipend from your employer now. It's not subject to any restrictions, meaning they can't force you to use that on any one thing. It's just compensation to you and is taxed accordingly. You have another $2,500 in wages, let's say, in your example. I think, Dave, the bigger issue is, and let's simplify this, because the rules here are fairly complex, but let's simplify this and say that, an entity with 100 employees, they are not exempt from this mandatory health insurance coverage. So they would be subject to a penalty per employee that they fail to provide health insurance for. And let's just say, for all intents and purposes, that penalty is $2,000 per employee, which is kind of the real simple and basic formula. 100 employees, $2,000 per employee, a $200,000 penalty assessed to that employer. Well, when the employer compares their $200,000 penalty to the additional salaries or stipend that they're offering to their employees, I think you could say in some instances that would still be less expensive than providing health insurance at, as you said, which is maybe a growingly less competitive rate than what can be achieved through these exchanges.
Right. It's a key question that employers have to ask and continue to evaluate going into 2015.
And I will say from this perspective too, this is a good time while we're talking about some of these laws and while we're giving you the tax impact of it. There's some other employment aspects to this and legal employment aspects that fall under discrimination rules and other things to where it really is beneficial to seek out the advice of someone beyond just your tax professional or tax advisor when you make these decisions. Because yes, we can give you the tax effect of it, but there's a lot of other pieces at play here from a legal perspective, an employee benefits perspective, and so on, to where, I would not go out and buy insurance based on what your tax guy said. And I also wouldn't really take your tax planning advice from a benefit specialist. So
certainly,
so really make sure you look at this kind of full circle and get your HR people, your benefits people, maybe potentially benefits attorneys involved to really examine this. But Dave, to your point earlier, this is an important question to be asked because it seems as though things are swaying toward there not being the level of traditional benefit we used to see from being part of an employee-sponsored group, an employer-sponsored group plan. It just seems to be diluting a little bit.
One of the other things that's just simply an informational matter for 2014 is that employers are reporting the benefit that they provide employees in terms of health insurance coverage, and the IRS is continuing to compile that data. I think it'll be interesting to follow how that information is used in the future, because the health insurance market is a very, I don't want to say volatile, but it's certainly going through a time of change. This legislation has a big impact, and you can't always predict how a piece of legislation this large is going to impact, the health insurance sector. You have to let it play out a little bit. And I think there are interesting things. Maybe some were anticipated, maybe some weren't. But I don't think it's going to remain the same for very long. I think there's going to be some very good things, some opportunities that are going to be seized. I think there's some weaknesses that probably will be shored up in the future. So it's certainly an area that is continuing to evolve, both in health insurance providing by employers, by health insurance companies, by hospitals, and the tax impact of all of those benefits.
Dan, I just want to kind of get back to the law that was passed in December. We touched on what we think is the most important provisions from a business standpoint, from a corporation standpoint, from a flow-through standpoint, and an individual standpoint. But there are many, many other provisions that were included in the law. And you could do that on the list. There are a bunch of credits that are seldom used or I've never seen some of them used. Very specific, targeted credits that are kind of always updated in these bills annually. But from aside from the ones that we never see, those targeted ones, are there any other specific provisions that you would see as important?
Yeah, Ryan, I think that's a great point because there's a lot in here, and we're not going to touch on every one of them. But another one that I think is important to note, because I think it has a fascinating economic discussion around it, is the idea that the extension of the exclusion of home mortgage forgiveness of debt. Tax concept is if someone forgives your debt, generally speaking, cancellation of debt is income to the recipient. So if a credit card company forgives your debt, if a medical company forgives your debt, if a mortgage company forgives your debt, generally speaking, that is taxable income to you. The one provision that I guess comes right after that is the taxpayer is insolvent, bankrupt, or otherwise can't pay for it, proven by the courts. Then they don't have to pick that amount up in income and then pay taxes on it, because essentially it would just be a cyclical event. The IRS assesses income on your tax forgiveness, on your debt income forgiveness, and then you are bankrupt and have no money, or this forces you into bankruptcy and you have no money to pay taxes and such. So this was an important provision out of a lot of the foreclosures we've had over the last 5 to 6 years in the country, and specifically in the higher income or higher home values. Someone with $1 million home who could no longer pay for it would have, as part of the short sale with the house taken back and sold at auction, maybe they'd have $800,000 of debt forgiveness. Include $800,000 in income at 39.6%. Now try to pursue this person. If that person had enough money to pay that tax bill, they would have had enough money to keep their house. So all this exercise did was prove that this taxpayer, or force this taxpayer to be insolvent, which meant that the income was not taxable anyway to them. So I think Congress, and working with the IRS, I assume, actually just kind of said, listen, our enforcement efforts of trying to include this forgiveness of debt in income is going to produce no additional revenue for us and for the country.
But there will be a cost associated with those collection efforts from the IRS standpoint.
Right. Great point. I mean, we've read articles a lot recently about the IRS and their budget challenges and having less audits, having less staff to enforce the Affordable Care Act. And this, would have been a zero-sum game. Let's pursue all these people and force them to include in income this debt cancellation, thus making them insolvent, which means they wouldn't have to pay the taxes due on it. Therefore, let's just allow $2 million, up to $2 million of debt forgiveness related to your personal residence to be exempt from income. And taxpayers can just essentially move on from that foreclosure or short sale without tax implications.
Yeah, the IRS is up a kind of between a rock and a hard place. We talked a lot today about the Affordable Care Act and what that means, and it's a lot to digest for taxpayers, but the IRS has been the ones that have been mandated to kind of collect on these penalties. Mm-hmm. But at the same time, if you've been reading the news, you'll see that the budget for the IRS has gotten tighter. So it just seems like they're asked to do more with less, and provisions like this, exclusion of home mortgage forgiveness, seem to make sense.
Taking a view towards the future, one big item in the news recently, President Obama's State of the Union address was Tuesday night, and he talked a lot about tax reform, his ideas for tax reform, some of the things he's going to be proposing. What in his speech do you think we should be concerned about? Are his proposals, are they feasibly going to be law in the near future? Or what do you think was noteworthy about his particular tax ideas?
Well, kind of what I was going back to earlier about capital gains, the report I read is that, we look at a current capital gains rate of 23.8%, which includes that Medicare surcharge. The proposal that's being put out there is for capital gains to go up to 28%. And there are a few other provisions included in these, or a few other proposals included that seem to target high-income taxpayers for the benefit of middle-class taxpayers. And if you fall into that former category, I would, my personal opinion is to not get too nervous or anxious about it, because Obama, while he has these proposals, is dealing with Republican Congress. And if you look at what the Republicans have put out as proposals and compare it to what Obama is stating, they're very much at odds with each other. There's not even much room for compromise because they're ideologically so different. Dan, would you agree with that?
Yeah, there's a lot of tax legislation that makes its way around Congress in general that you don't hear about in the news, and we follow a lot of it, obviously, because of being in the profession that we're in, and a lot of it just doesn't gain traction. But you don't hear about it in the news because it's a little bit extreme, if you will. I happen to think that the proposals that were discussed here fall into that category. If you look at the political environment that we have, I don't believe there is any true likelihood that these provisions will gain traction in Congress as it currently is. Because of that, we're not paying them much attention, other than to say right now we have no reason to be on alert that these changes are coming forth, Ryan, just as you alluded to. I think the system we have now, which essentially came out of the fiscal cliff a few years back, this is the system that we're going to be operating with for the next couple of years. Almost, depending upon those last minute fixes on bonus depreciation and other things, I don't see there right now being any type of sweeping or meaningful tax reform on some of the issues that you spoke about. Those are not bipartisan support issues. Raising tax on high net worth individuals, high income individuals, raising the capital gain rate. That's not something that's going to get bipartisan support like R&D would, or like bonus depreciation 179 would. So a lot of those types of items, as they start to come through in the next year or a few months from now, I don't expect them to get much traction at all.
You do read a lot about bipartisan committees, bipartisan commissions, and every once in a while who have very lofty goals of broad, sweeping tax reform, but very little of it, as you said, actually makes it through the entire legislative process. So it's kind of something to monitor, but I think what we're saying generally is don't overreact to speeches that are more about the political rhetoric, more about casting a larger vision than they are about passing a specific law in the near future that's going to, immediately raise taxes on a number of Americans. That's just not in the near term.
Great. Well, I think what we're going to do now is spend the rest of our time maybe answering some questions that have come in, guys. So thanks for listening thus far, and now we'll take some of your questions that have been coming in throughout the presentation.
Thank you again for joining us for today's webinar, Year-End Tax Legislation. How will this affect you? Brought to you by McKonly and Asbury. We will be sticking around to answer some of the questions that have come in, so please continue to submit them via the chat function. Dave, Ryan, and Dan will be happy to answer them over the next few minutes. Join us for our next webinar on February 19th, titled How Fraud Risk Assessments Fit in Your Organization. This webinar will be hosted by McKonly and Asbury partner Janice Snyder, Principal David Hammerberg, and Senior Manager Sam Bowercraft. This webinar will provide an in-depth look on how to prevent fraud in your organization and how a fraud risk assessment is a proactive approach to reducing the risk of fraud. As a reminder, you will be receiving CPE credit for attending today's 1-hour webinar. CPE certifications will be sent out via email within the next 15 days. Also, you will be receiving a follow-up email to this webinar with a link to a short survey about the webinar, and we would appreciate your feedback. We will be posting a copy of today's presentation on our website at www.macpas.com/news. Look for that post to be up in the next few days. Now, let's go back to Dave, Dan, and Ryan to answer your questions.
All right, well, a couple of questions that came in that I think are good ones we definitely want to address. So the first one I'm going to direct towards you, Ryan. It was, could you clarify the difference between 179 expense and bonus depreciation that you discussed earlier? So again, clarifying the difference between Section 179 expense and bonus depreciation.
Sure. Yeah, this is a common confusion or source of confusion, I think. Both, from a high level, both deal with accelerating deductions of fixed assets and recovering fixed assets. On a high level, bonus depreciation is less advantageous, but also less restrictive. Mm-hmm. Whereas if you fall within the parameters of Section 179, which tend to be a little tighter, it's more advantageous. Some of the more nitty-gritty detail, bonus is 50% by definition. You can take 50% of an asset's cost, but it has to be new. 20 years or less of tax life, which is usually throws out real estate unless, as we talked earlier, about qualified leasehold improvements.
Right.
Whereas Section 179 property, in order to take it's full expensing, so you can take 100% of the cost of a property as an expense.
Mm-hmm.
However, there's a $500,000 total limitation to it, and once you cross over $2.5 million of capex, you can't take any. So that's where it gets more restrictive. There's also a loss restrictiveness to it, whereas if you're in a loss, you can't take Section 179. That's not true with bonus. Lastly, the bonus property it has to be new. Section 179 can be used property as well.
So they always hear 179 new to you, whereas bonus being new overall. So if you bought a used car to use in your fleet in a business, it would be eligible for 179, but not for bonus, correct?
Correct. We won't get into it now, but the autos have their own band of restrictions for both bonus and Section 179. But by and large, yes, generally what you're saying is true.
That's right. Another question that came in, and thank you, Ryan, for clarifying that. Another question that came in directed towards the health insurance credit, which typically focuses on small businesses, is can you clarify exactly how to go about claiming that credit for small businesses? Dave, I'll let you tackle that one.
Yeah, small businesses will continue to claim the credit just as they have from 2010 through 2013. With their annual tax filing, there's an additional schedule in which they'll lay out how many employees they have, the premiums that they've paid on behalf of those employees, and they'll calculate the credit that is due to them on that annual form. The only thing what has changed for 2014 is you have to purchase those health insurance plans through an exchange. So you don't get the subsidy when you purchase it on the exchange. It just qualifies you to claim your credit when you file your annual tax returns.
That's very helpful. So the mechanics of it from the accounting or tax side are really similar to prior years, if not exact. It's just the one extra, I would say, qualifying step of needing to obtain that insurance through the exchange that is really the big change or focus now.
Correct. It's not a change in the mechanics of filing your taxes. It's a change in I need to now purchase my plan through an exchange to qualify for that credit.
Well, great. Well, it looks like that is all the time we have for questions for today. The inner tax guy me would like to remind everyone that the reporting requirement for 1099s and W-2s is coming near in a week or so, so make sure you get those out for all the individuals affected or that need them. And thanks so much for joining us today, and please stay tuned, as Tyler mentioned earlier, for all the great upcoming webinars from McKonly and Asbury.
Thank you once again for joining us for this presentation produced by McKonly and Asbury, certified public accountants. We hope you join us and participate in our upcoming events. You can stay up to date with news and learn about our upcoming events by visiting us at www.macpas.com. Thanks again and have a great day.